evening, folks, and welcome to the Contrarian Trader. This is Robert Desmond. It is Sunday, November the 1st, 2009. Folks, last week the federal government released GDP report of growth last quarter of 3.5%. Like earnings, we knocked the cover off the ball. We beat estimates. 3.2% the estimate, 3.5% the real number. Sham. Absolute sham. I heard these numbers. I typed out a message really quick to my subscribers. Do not cover your short positions. Do not go buying stock. It's a scam. You remember that on Wednesday the market really tanked. Thursday they come out with the GDP numbers because they needed to recapture 1050. Remember, we have an election coming up this week, and a big race over in New Jersey is up for grabs. And if the Dems lose that state, brother, this Obama administration's got a lot of problems pushing legislation through Congress. Thank God. So please get out there and vote. Get this Corzine out. We got to put the brakes on this federal government. They are out of control. Let's get into these GDP numbers. Yeah, by and large, the GDP numbers were made up of cash for clunkers and the first-time home buyer tax credit. Now, here's a dirty little secret about that cash for clunkers. First, let's take a look at it. What they did is they spiked the production of motor vehicles up 157%. Think about that, 157%. This chart here goes back. This is the motor vehicle output of production by quarter going back to 1979. This is last quarter. Look at this spike here, 157% spike. The highest, which doesn't even come close, was back in 1979, 3Q 79, at about 95% increase. And it was probably due to free money going into the market as well. But look at this. And it's going to drop off in Q4. So you're not going to see a repeat of that in the motor vehicle production numbers. So be wary. And these folks that got this exemption, the dirty little secret here that you don't hear on the news at all is the fact that that's taxable money that they got. They're going to get a tax bill come April 15th on that money. So these games that the government is playing, it's going to wreak havoc on this market, and unintended consequences. This is an absolute nightmare that's developing here. These people had cars. They were jalopies, fine. But you know what? They're paying off their credit cards. They have a car with no payments. Maybe they didn't need collision and comprehensive insurance on the car. They needed just liability. It saved them on their insurance bills, saved them on having to make payments. But now what are these people doing? They're making payments, trying to pay off the credit card bills. Rather than trying to fix the problem, the government added to the problem. It's a joke. What fueled the GDP numbers as well last week? What was some organic growth that we saw? Some organic growth that we saw was from exports. And the only reason why the export numbers were high is because the S&P companies, which derive 45% of their earnings from exports, are dependent upon a weak dollar to help fuel their earnings growth. If you see a stronger dollar, as we predicted a couple of weeks ago we would, and we got it last week, it hurts their earnings when they translate their earnings from euros or whatever currency they're selling in back into U.S. dollars, and that goes directly to the bottom line. So the last thing these S&P companies want to see is a stronger dollar because it hurts them, makes the products more expensive overseas, and it hurts the profits when they come back over here to the United States. So watch out for this U.S. dollar. And just to stay on topic here for a moment, we went bullish on the dollar back here. And I caught a lot of heat for that call. And I just want to clarify, this is a trade only. The U.S. dollar has every reason to go down. I mean, we are structurally flawed in this country. The debt that we are taking on is just preposterous. It's a nightmare. Do I think there's a trade here in the U.S. dollar? Yes. We have not broken trend. We are still in a downtrend. If we break above this trend line here, which we're right at, then we could see a continuation of the rally. But this is a trade only at this time. In the long term, the dollar is going to come back down, break the new lows, and we're going to have a nightmare in this country. S&P 500. You got to look at, in times like this, when the market is rolling over, you really need to take a look at weekly charts, because that really tells a story. daily charts have too much noise, too much fluctuation, but a weekly chart gives you more of a smoothing out a view of how the market is. And you can see we're about to break below a trend line here. Volume rose last week for the second week in a row. It's the second down week, the new lower week, and we sliced through that 1050 level like a hot knife through butter, which is very, very bearish. I was really, truly surprised to see us break below that level. We did. I wasn't surprised we broke through it. I was surprised we broke through it so easily. And that was on the first shot we broke through it. We rallied back above it on Thursday, failed to hold it on Friday, and broke even lower on Friday. Brother, be careful. Just please be careful in this market. A couple of weeks ago, we said it's time to get out of the IWM, and we were opening up short positions, continued to in anticipation of a weakening market. And as the pundits on CNBC and Bulls and Bears are saying, buy stock, I was pointing out we have a double top here in the IWM, and as goes the IWM, the Russell 2000, so goes the NASDAQ. And the NASDAQ is corrected severely with semiconductors leading the way. Remember Intel hit the cover off the ball this earnings season? Look at it now as compared to where it was after it met earnings. It's really dropped dramatically. There's something fundamentally wrong with this economy. And look no further for that story with the retail holders. This is an ETF on the retailers in the United States. Take a look at this run since March of 09. You got to remember that the American consumer is dead, all but dead. The credit lines have been cut. The banks are screwing them with 30% interest rates. They're denying them on credit cards. The banks aren't lending. What are these folks going to use to buy new products this coming Christmas season? They're dead. They don't have any money. You think about it. The people that bought new cars, they have a tax bill coming to them. They probably don't even know it yet. So what are they going to use to buy new goods? I don't know what's fueled this run in retailers except for an oversold condition, but it was warranted. I wouldn't be a bit surprised to see the retailers lead the way down. So please stay away from retail. It's very, very dangerous. There are no earnings here. The XLU, I've stated as one of my bearish cases for bearish reasons that I believe that this market's going to go lower is that there's going to be a rise in interest rates. That's why I thought there was going to be a rise in the dollar as well, which just turned out to be correct. And I've told my subscribers on a daily basis, watch the XLU because the XLU tracks the utilities. Now, the utilities are capital intensive. They need dollars, fresh dollars, to be lent to them so that they can expand their facilities, maintain their facilities. That costs a lot of money. Those are union jobs too. And they just can't simply raise prices without going to the state first. They need to borrow money. And the cost of capital is very important because it goes right to their bottom line. Look at the XLU. It's breaking down. What that's telling me is that the markets are anticipating an increase in interest rates. And the utilities are always first to act. It's like a canary in a coal mine. Watch the utilities. When they break down, so goes interest rates because they're probably going to go the opposite way. As utilities correct, interest rates go higher, vice versa. The transport's breaking down as well. I brought this to my subscribers' attention as well. We see a break below here, this 3,500 level, get out of this market. The Dows can't head higher without the transport. The Baltic Dry Sea Index, I've been watching this one closely. Left shoulder, head, right shoulder. If this completes this formation of a head and shoulders top, the China story will be over because this is all a China play. We went short a couple of weeks ago. I caught a lot of heat for this trade as well. The FXP, which is a short fund, which tracks the Zenshu 25, which is like the Dow Industrial Average of China. That index is made up of 30% banks, 18% commodities. Now, the Chinese government has been stating that they have to slow down growth over there. They're afraid of inflation, and their stimulus funds are pretty much running out. So you can expect the pressure on the banks and the commodities to really get hammered over there. And it's starting to prove out in this trade. We have a profit in this trade. So we plan on staying long that trade. Axel, we took profits. We bought it back here at $1.15 like an option. We made a lot of money on 600% profit on this trade. We sold into Friday morning's action, that rally. We saw the market going down, Axel going higher. I don't think so. We sold into that rally. We got out at about $7.15. We made a nice profit. Congrats those who joined in. NBEC, you remember that Kramer said, get long back here. We said, you're nuts. Stay away from it. It's down tremendously. We're going to probably look to get into this about $36 level. I'm going to send an alert out to my subscribers for trade only. This is a broken stock. This is going to be short covering trade only, not an investment. Folks, if you want to be a member of the Contrarian Trader, please sign up for a 14-day free trial offer. Don't listen to these thugs on Wall Street. They're trying to rob you. Fancy pants walls, $2,000 suit traders. They're selling you. They're not offering you advice. You don't have an account with them. Join the Contrarian Trader. Get on the side of us, and we will stay short this market together, okay? Have a